Welcome to This is Wealth. On this podcast, we ask, what is wealth? What does wealthy really mean to you? Most of us immediately think of money, but honestly, wealth is so much more than that. If you have health, deep friendships, a supportive family, you have great wealth. My name is Liz Crawford. Get ready to be impacted.
Today, Sendero's very own Kristina Craig joins us. Now, by training, Kristina is a CPA, and she has extensive background in tax and estate planning. She is part of our family office team, and she helps keep us aligned in how to think about clients' estate plans, tax strategies, what's changed in the law, and how do we need to think about it in terms of how it helps or possibly may need some changes to clients so that they're in their most advantageous tax position. The tax updates is what brings us to our conversation today. The recent passage of the big, beautiful bill brings us to some changes that we thought we should share, talk about, and help people know what's come through that. And as a big, beautiful bill, there's a lot there to unpack. Thank you for joining us, Kristina. Why don't we just start kind of high level? What are some of the big takeaways that were in the bill?
The bill itself was really a big bill. I mean, just kind of as the name says, lots of information in there, lots of provisions in there, not just a tax bill, although the focus is really on the tax pieces that were implemented by the 2017 Tax Act and, how that would impact as it was set to expire at the end of 2025. It was a reconciliation bill, which is an interesting process between the House and the Senate. And what that means is that they had to come to an agreement. So lots of modifications, lots of back and forth, even just small pieces, not just things that got accepted. So it was really an intense process. There was a very tight deadline that was set by the president to get that signed by July 4th. Lots of work went into the bill, and it is a massive bill from what the information really put out.
So let's dig into this bill. What does it mean for individual taxpayers?
So I don't think we can really cover everything. Lots of pieces in there, but just as a couple of highlights, I think one important piece is that we're keeping our tax rates. That's a big deal for a lot of families. The tax rate was 39.6%. before the 2017 Tax Act. It got reduced by President Trump in his first term. We're going to keep those rates. The highest tax rate for individuals will stay at 37%. Capital gains tax rate, the highest rate, will stay at 20%, which is great news for families. Previously to the Tax Act in 2017, we had personal exemptions, we had standard deductions. That got changed. The rules got changed. The personal exemptions get eliminated in favor of a higher standard deduction. And we're keeping that. We're not going back to the dual deduction perspective. So we're retaining those for 2025. Basically what that looks like for families, filing jointly, that's a $31,500 deduction. For single taxpayers, that's half of that.
Okay.
So that's really great news that we're keeping some consistency in some of the tax laws that we have seen. In addition to that, we got a new rule for seniors. And so for 2025 through 2028, they're going to get an additional $6,000 bonus deduction, whether the itemizers have a standard deduction. In either case that applies. There's an income phase out for that. That was the response to the no tax on Social Security income. That didn't make it in the bill, so we're still going to have Social Security income taxed. But we at least have a temporary rule that gives seniors some benefit in certain tax brackets. One very big item was the miscellaneous itemized deduction that was set at the 2% floor in previous years. That was eliminated by the Tax Act. Really what we're talking about is these itemized deductions such as your safe deposit box, your investment interest, your tax preparation fees, unreimbursed employee expenses. We lost that deduction in 2017, and that rule is going to stay in place. So we're not getting that back.
Okay.
Mortgage interest, another big item. People like to take their mortgage interest deductions. The cap on indebtedness. So for loan balance, it was set at $750,000 in 2017. That remains in place. And home equity loans are still not eligible to be part of that calculation.
Not eligible.
Not eligible, I think, is a big one to keep in mind.
Yes.
So it's really looking at your primary resident mortgage when it comes to this deduction. Here's a big piece of the legislation. A lot of people have heard of SALT deductions. I think there's a lot of back and forth. Really what we're talking about is the state and local income tax deduction. It used to have not a limit on that. In 2017, it got put a phase of $10,000 on it, which really, that's a tough deduction to lose, especially for individuals that have state income tax that they have to pay.
Yes.
So there was a lot of back and forth between the houses on that. And what they ended up with is a $40,000 temporary increase to that deduction through 2028. Everybody gets to benefit unless they exceed income of $500,000 annually. So there will be a phase out calculation. Congress and the Senate spend a lot of times figuring out how they want that to look. But that's a piece that will, be in place. You cannot go on the phase out lower than $10,000. So even individuals in the higher tax bracket over $500,000 in income will at least get a $10,000.
They won't lose what they had before.
They will not lose what they had before. That is correct. And that law gets phased out. Unfortunately, that deduction does not stay permanently extended. It is phased out, and will revert back to $10,000 in 2030. So here's the additional piece to, I think, that we didn't have to deal with over the last few years. And that is a limitation on overall itemized deduction.
Okay.
We used to have that. We used to have a phase out calculation around that, which was called the PEAS limitation. And we didn't get the PEAS limitation back, but we got a very interesting 237th rule. And really,
wonderful.
All that means is that there will be a limitation for individuals in the highest tax bracket. So it will base the phase out on the thresholds of the taxpayers in the 37th tax bracket. It's a very interesting calculation. There's complexity to it. But it really will impact those taxpayers in the highest tax bracket and not in the lower tax bracket.
Okay. Lovely.
Yes, lots of
237th rule.
The 237th rule. It's really about 5.4% when you do the math of what that looks like.
Okay.
But overall, it is not as simple as the PEAS limitation was, but it still does give more benefit overall to taxpayers that are not in the highest tax bracket.
I may not be able to calculate my tax returns, but I can calculate that I need to keep my CPA.
Yes, all right. Definitely a good recommendation. As we're seeing these pieces come into place, there's going to be more interpretation that we're seeing over the next few months.
Yes.
And it's just making sure that you stay with your advisors, you stay close to your CPA, have those conversations early so you don't have a surprise.
Right.
Comes tight.
So they're finishing tax deadlines now. Then they're going to go into continuing education, learning about this bill, unpacking things. There's still pieces to be written, tables to be, given by the IRS. There's still a lot of work to be done.
There is still a lot of work to be done. Absolutely.
Okay. We've talked about individuals. What does this mean for small businesses?
There were some really interesting and good legislation in the bill for businesses. And it was really a pleasant surprise to see where both the House and the Senate were set on really helping businesses. One of the big pieces in legislation has to do with depreciation. We call bonus depreciation, which is that first year deduction. And over the last few years, the deduction was in place, but it got reduced every year. So it's a percentage of what you were able to deduct. We're back to 100% first year bonus depreciation, and that's permanent, which is a wonderful thing for businesses as they're investing in equipment, in assets that they need to produce their products, to do their business. So for a rental, I think if you're giving some examples from a rental perspective, you have your own rental properties. What that means is it's really designed for property that has a 20-year or less depreciation method. So your equipment, your improvements itself, it's not designed for the building. So if you have a rental property, it's not the building that you get to deduct because that's a 27.5-year depreciation. But if you make improvements to the property or you need to put fencing up, those things will fall under that, which is a wonderful incentive to really invest in your income producing property. There was a new rule implemented or a new category of property put in place, and it's called the qualified manufacturing property. And so that's a term that never existed before. And it's intended for companies that have non-residential real property and that are producing tangible property, not food and beverages per se, but that are using that property to build products that they're selling. And so that rule gave them the ability to even deduct, for example, your building where you are producing that product. It has to be constructed in 2025 starting. It has to be put in place in service before the end of 2030.
Okay.
But it's a great opportunity for small businesses that are creating products. So your welders that are building fences or gates or any type of personal products that are selling. So wonderful opportunity for investment.
So if you were considering growing your company, now would be a good time to put that building in place to help grow capacity.
Absolutely. The interesting part to this rule is that the timing of the purchase of the asset or the construction has to be dated after January 19th of 2025. So it's not your typical first of the year or last of the year approach, but just knowing that that time frame is available to you will really help in this particular case. Really, in addition to that, research and development cost is a big piece for a lot of companies that are producing, that are creating new services. And we used to have a 15-year amortization for those costs domestically and foreign. This bill made the domestic cost 100% deductible, which is fantastic for small businesses or any company per se. In addition to that, small businesses, we're talking really about businesses that are under 31 million in average gross receipts. They get to use that retroactive 2022. And having to amend your tax return. If you don't choose to do that, you can accelerate the remaining deduction that you have in place. But what a great opportunity, right, for companies to really feel the increase in support of being able to produce. It was a goal, I think, from the president to really foster that manufacturing, the small business industry, and those types of rules in the bill will really help with that.
That's great. That's fantastic.
One other piece I think I would like to mention is the SALT deduction. We talked about this a little bit on the individual side, and historically that wasn't really applicable to businesses. And the original bill presented by the House would have made it potentially applicable at a threshold deduction, primarily for service industry businesses. There was a lot of things that went into lobbying, and the final bill made it permanent that there is no limitation for the deduction for small businesses, including service businesses, which is a fantastic win for small businesses overall. And we're really talking about your attorneys, your architects,
Right.
your advisors, those would have been impacted by that rule. And just knowing that that's not impacted now is just a great win.
Very good. Very good. Do we have more good news?
I think we have some other non-tax news that really came for the businesses in place. There's a lot of credits in the bill that I think people can really dig into. CPAs are really going to learn about, whether that's energy credits or other credits. But one non-tax related item, at least not from a taxability perspective, but more in an administrative perspective, is that they're raising the threshold for 1099 filing requirement.
Okay.
It's not a fun thing to talk about when you're, really looking at tax law. But overall, this is a great win from an administrative perspective because it takes a lot of the burden out. Current threshold is $600.
Mm-hmm.
That's not a big number when you're having to issue these forms to your vendors and suppliers. That number is going up to $22,000.
Okay.
Will be adjusted for inflation going forward, which is even better. So we're starting to keep up with really what the market is doing and what the industry is doing overall as we're seeing inflation increase prices.
Keeping it relevant.
Yes, absolutely.
We've covered taxes both individually and for businesses. What about the estate and gift tax implications? This is always a hot topic.
Absolutely. Great news there, really. I think there was a lot of talk about the expiring law. I was going back to previous of 2017. And so great news there. We received the permanent increase, $50 million of lifetime exemption for individuals starting in 2026.
Okay.
So fantastic news there. And lots of planning opportunities for clients with their advisors and CPAs to see what that will look like. That means it's a $30 million IPEN exemptions for couples.
Perfect.
From a planning perspective, 529 plans are really very common. Lots of people utilize that to fund that for their kids or grandkids from a gifting perspective.
Great tool.
We haven't seen any increase in the amount of deduction that it can give, but what we have seen and received is the availability of additional types of expenses. So they broadened the categories for K through 12 homeschool expenses. They added credentialing expenses, postgraduate for individuals to use that. That was not previously allowed by 529 plan. So that's your attorneys, your CPAs that are going through the process of getting their licenses, and great opportunity to be able to utilize more of that.
Sounds like we can make these plans a little bit more usable in
Yes,
the area getting up to college, and then even a little more post-college.
Absolutely. Some of the thresholds for K through 12 expenses that also increase. It used to be $10,000. Now you can use up to $20,000 annually.
It's very
So wonderful news for families that have funded these plans.
Right.
And really to use them well and for their intended purpose.
Love that.
In addition to that, we got a really new, interesting aspect of planning gifting, and that's called the Trump account. So from a perspective of understanding what that is, there's a lot of different information out there. So we're still learning. There still has to be a lot more guidance. But what we're seeing right now, it is a tax advantage savings account for kids that can be funded by parents, grandparents, relatives, but also by employers with an annual threshold of $5,000. There's a pilot program that's established that says to fund the account with $1,000 provided by the federal government for all eligible kids that are U.S. citizens born between 2025 and 2029. And we don't know really what that looks like or how that's going to get established, but that's a pilot program we're going to hear more about over the few months that are to follow. Overall, the account is designed similar to an IRA. So it cannot be touched until the child actually reaches 18.
Okay.
And after that, it converts into an account similar to an IRA. So it's going to follow those rules in regards to what it can be used for. So as long as it uses it for those exemption amounts that are available for the IRA, higher education, first-time home buyer credit, with all the limitations that's come with that, those deductions are penalty-free, withdrawals that can be made. Anything beyond that would fall under that, age 59 and a half rule with a 10% penalty if you're withdrawing prior to that. But it's such an unknown area of how that was supposed to really work that we're still waiting on a lot more guidance around to that.
Interesting new nuance, and we'll see how it blooms and what we're actually given there. But interesting, really interesting, especially the part that a company could help.
Absolutely. I think we're seeing interesting aspects to that, taxable versus not taxable, and what that can look like. There are thresholds that they're establishing currently, and it will fall under that maximum amount of $5,000.
Right.
But it's still a great opportunity, a potential great opportunity, at least for families, to see what can happen there. I think from an overall planning perspective, I would say, lots of good nuances in there, making sure to stick with your advisors to really go through what that looks like individually. Everybody's a little bit different in that regards, but also not to forget the current planning opportunities that are already there, right? We have a $19,000 current year exemption per donee. People can gift that amount to whoever they want, and it doesn't become part of taxable gifts. Payments such as medical or education expenses that go directly to organizations instead of an individual, I also don't count as taxable gifts. So utilizing some of those strategies and not forgetting about them is also really important.
Yes. One thing that we talk about is if you plan on helping out a son or daughter or a grandchild with tuition expenses or something like that, please run it by your CPA or your financial advisor before you do so that you don't miss that opportunity to have it not count on your gifting and you pay it directly to the institution. Doesn't seem like a big deal, but these little decisions and how you execute it can really have an impact.
Yes, I think there's lots of opportunities for family members because we were looking at some of those and the categories that you're eligible to make those tax-free gifts. It's as simple as finding the, retirement home,
right,
living facility for your, aging parents. Those pieces become very important.
Right. It can make a big difference.
Yes.
With so much focus on extending the 2017 tax cuts and making them permanent, what did we really accomplish?
We really didn't accomplish making it all permanent.
Right.
From a realistic perspective, I don't think we'll ever see that in any types of tax legislation that would all encounter. So I think from perspective, we did see some impactful changes that were permanent. The tax rates, for example, that we've already talked about, making those permanent is a wonderful piece for individuals to know. Keeping the standard deductions at that higher level and removing the complexity of personal exemptions that have rules around it as well. The bonus depreciation for the businesses and the research and development cost deductions that we're seeing. Those pieces are, very impactful and, should be really considered as a big win in a lot of ways.
Very good.
There's temporary provisions, of course, and things like the seniors additional deduction that we talked about that expires in 2028, the SALT deduction that goes away, in 2030. We didn't get to keep those in permanent status. They're going to get revisited as they are approaching expiration. But it's an uncommon scenario that we will get extensions across the board. It was already big legislation in 2017. this is similar big legislation, and we're going to see those nuances between permanent and temporary provisions. We get some interesting ones on the temporary side too. We got a new rule that has never existed. Nobody was ever able to deduct your interest payment on car loans.
Right.
But we got a very interesting stipulation now with this act that we do get to do that, at least individuals for a certain income threshold, up to $10,000 in deduction for U.S. manufactured cars. They have to be new vehicles, has to be new loans. It does expire after 2028, but what a wonderful additional piece of legislation.
What about any surprises that came from the Hill, good or bad?
Yeah, I think we had some surprises. I think some unique pieces of legislations that I think were very unexpected. We received a excise tax on foreign transfers. This has never been in existence before. And what we're talking about there is a 1% transfer when U.S. citizens transfer funds to foreign recipients. It gets collected by the processors of those payments and withdrawals. The intent is not to penalize, your U.S. citizens where they transfer funds to another U.S. citizens that may be living abroad, like your child, on foreign study, or temporary residency that opens a bank account overseas. That's not the intent of it. It is really to not incentivize individuals to transfer funds to foreign nationals. Yes.
That kind.
Yes, absolutely. Another piece of legislation that didn't get quite as much attention is the nonprofit side of the bill. There was a little bit of back and forth around that, and the focus was twofold, but primarily this impacts endowments of public universities with students of 3,000 or more. And excise tax is not an uncommon factor for nonprofits. There was a current rate of about 1.4% excise tax on that investment income. And they really are targeting those endowments, those larger endowments and those universities that are not public for excise tax. And what they've done is they created a tiered level. It starts at that 1.4%, goes all the way up to 8%. So it's something to really be mindful of as you are working with and at those universities that are going through that. They're seeing an increase in their overall tax. It was back and forth that this would also apply to private foundation, and it did not make that into the bill, which is great news.
Right.
So private foundation will keep their about 1.4% rate, but what they will be seeing is an additional scrutiny in regards of filing requirements, and it's really more of meeting those regulations around self-dealing, reporting requirements on your grant processes. But we'll be seeing more of that over the next few years for private foundations. So something to be very mindful of and be prepared for.
The administration of your private foundation just got a little more
Absolutely
heavy.
Yes.
You need help in administering it and making sure you're compliant from a tax standpoint. Yeah. Your policies and procedures need to be in place.
Absolutely.
And you need to follow them.
Yes. And it's so important to begin with. And there's a lot of rules around how to maintain your charitable status, especially for private operating foundations. But, this is a little bit more heavy burden now that they're more popular. What we don't know is how that's going to look.
I know you will be educating our foundations and philanthropy group back at the office, keeping them abreast of what's happening and how we can work with the tax preparers for that.
Right. I think from your question around biggest surprise, I think that's really around charitable deduction. It kind of leads directly from those nonprofits. But we're seeing that on the individual side too. And what we have received in this bill is a first time ever floor on charitable deductions.
Interesting.
On the individual side, that was never in place. This was on the corporate side. We've seen that. There was a floor in regards of your deductions and what you had to meet before you can deduct anything. We see that on medical expense deductions, that has a floor around income. So this is a big surprise. What that means is for anybody that's itemizing, you have to meet a 0.5% floor of income in order to deduct your charitable contribution. So whatever that floor is, anything above it, you get to deduct, which is very unique.
Yeah.
And it will impact a lot of people.
Interesting. Really interesting.
What we don't know is what the base is for that. It's called contribution base. And we're thinking it means your adjustable gross income, your taxable income could be another contribution base. So we're waiting on more guidance around that. But that's something to be very mindful of, that will impact itemizers that have charitable deductions. On the good news, we now have charitable deductions for people that do not itemize.
Okay.
And that's in addition to their standard deductions. So if you're a single taxpayer, you can deduct up to $1,000. If you're married filing jointly, you get up to $2,000.
Very good. Very good. Yeah. Take some, win some, lose some.
Yes, absolutely.
It's government at work, and we'll write the rules later.
Yes.
Yes. So out of all of this, what comes next?
There's a lot of work. I think we talked a little bit about this earlier. There's still a lot of work. This is a very broad bill. There's definitely sections in the bill that need a lot more guidance from the IRS. That means they have to write revenue procedures. They have to change forms. Just to bring, really wrap around this bill to get all of the different pieces in place that will impact not just 2026 and going forward, but also current year 2025.
Right.
We've already heard from the IRS that they will not be updating some of those tables that are currently in place, such as withholding. They're not going to change some of the forms for 2025, such W-2s that could be impacted because we're getting some rules around tips,
right,
deductions, things from a reporting perspective. But overall, that's something that we need to keep in mind. There's just a lot more to come, a lot of different information on some. So just to be very cautious, be very mindful, just stay very close to your CPA and advisors in the process as more things are getting rolled out. We also know that the IRS, they lost 25,000 people, in the process. You're getting a new IRS commissioner.
Right.
So there's a lot of things even happening in the IRS right now that, we'll see how smoothly everything gets rolled out. Tax season typically starts sometime late January, early February. There's a chance some of that gets pushed. So this is just something to watch out for. We just don't know what that looks like yet overall.
Yeah. Wait.
Lots more to come.
Just, complexity. When you have a big bill that makes big changes, there's a lot of work and it just takes time and there's no way to rush it. And that just means we all have to be a little patient and stay educated on it.
And really that recommendation, I think that's really important. Just really talk to your advisor, ask lots of questions. They may not know all the answers yet, but they'll get you the answers that you will need to make sure you make the most educated and best decisions for your family.
Well, and again, if you're considering making changes, investments, big strategic decisions,
yes,
make sure you know the pieces before you pull any levers.
And bring in your team. Making sure you really surround yourself well with a team of advisors that can help you navigate all of that.
Right. I think we will probably be talking again.
Very possible.
There's more to unpack as it is written. So thank you very much for your time today. And I know, for our clients, if there are ever any questions, that you're always available.
Certainly.
We certainly welcome the conversation and the dialogue back and forth. It's really, that's why we're here. Thank you so much.
Well, there are so many great conversations that come from discovering the true wealth in your life. And I feel that when you see wealth for more than money, you will have true clarity in what matters to you. And that clarity will help you in every decision you make. Thank you for spending time with us. I look forward to the next time you'll join us. And remember, wealth is a lot more than money.